Welcome back, everyone. Today we're going to try out something a little bit different here at Chip Stock Investor with our format. Please let us know if you like it later in the comments. But today we're going to focus on some major players in the semiconductor industry. We've had a ton of earnings the last couple weeks and more to come. But today let's focus on Intel versus AMD, on Semiconductor versus Texas Instruments, and KLA Corp.
Yeah, we wanted to try something a little bit closer to a podcast because there's a flood of information that we've been hit with by these semiconductor companies. Maybe just a quick reminder, when we started this channel almost 7 months ago, we highlighted three things that we thought would drive not just the semiconductor industry forward, but really the whole pace of technology development in the years ahead. New chip architectures, new chip materials, new chip substrates, and a tighter integration between hardware and software development. And I think the reason we wanted to do more of a podcast style here is we actually have received a lot of information just in the last 2 weeks from these companies that really kind of put that on display. I did not come up with that idea myself, those three things that would drive chip development going forward. It comes from the companies that we're invested in. And I think they're starting to demonstrate what that actually looks like. So that's the 5 company kind of roundup that you mentioned, Casey. Before continuing, let me remind you to hit the like button and subscribe to the channel if this video is helpful as you do your own investment research and increase your knowledge of business and technology. We really appreciate the support as subscribing to the channel helps us continue putting out content like this.
Let's kick it off with Intel's first quarter 2023 financials. So revenue was $11.7 billion, gross margin of 34%. Operating margin was down in the negative territory at 12.5%. Net income was also negative, $2.8 billion. Earnings per share, also negative, 66 cents. Free cash flow was 9.2 in the red. So some painful numbers here, but maybe we can break this down a little bit, talk about where Intel's at. We know that they're trying to make a very big turnaround here. So Nick, how do you feel about these numbers, and are they on track to make their big comeback?
Hopefully no one is tuning in just to hear a rant on Intel. I'm done with my rants. The numbers obviously were horrible, but expected. It was actually at the high end of management's guidance. The one figure I'd maybe home in on that you mentioned was the 9.2 billion loss in free cash flow. If we were to annualize that number, Intel is a bankrupt business by the end of 2023. So horrible. But the good news here is the company is probably not going bankrupt, because this quarter was probably the bottom. If not Q2 2023, the quarter that ends in June, will be the bottom before they return to sequential growth. Their profit margins, including free cash flow, will improve. Free cash flow is going to return to positive territory the second half of this year. So while the headline numbers were awful, horrifically awful, this was expected, and it looks like Intel is going to return to some sort of sequential growth later second half of 2023, which is largely in line with the entire semiconductor industry, especially that portion of it tied to PCs and smartphones and other consumer electronics.
So before we dive a little bit further into some of the comments that were made in the earnings call for Intel, can you switch over to AMD and kind of tell us a little bit about what their financials look like for this quarter?
Okay, so I'll lead off here by saying AMD is our pick. That's where we're invested between these two companies, historical rivals and still rivals to this day. And I'm not going to give AMD a pass. It wasn't a great quarter. Revenue was down 9% year over year. But remember, they were still getting about half a quarter's worth of benefit from the acquisition of Xilinx last February. So their revenue actually would have declined a lot more than 9% if Xilinx had been completely removed from the equation. Also, some of the same factors that impacted Intel also obviously hit AMD as well. On a GAAP basis, they generated an operating loss of 145 million, although they did generate a profit. When you adjust that number, free cash flow was over 300 million. So they're also going through a pretty rough patch here, obviously. And it's the same thing. It's that PC segment in particular that is really dragging things down. Their client group, PC and laptop sales were only 739 million versus over 2 billion a year ago, and the operating loss from that segment 172 million. So AMD doesn't get a pass, but the financials obviously looked a lot better than Intel's.
Thank you for going through those for us. So let's talk a little bit more about some of the comments made by both CEOs and their financial officers there. Pat Gelsinger made a lot of comments about the PC market and the expectation that that's going to grow in the coming quarters. Is that going to turn this around? Do you think that that's going to have that big of an impact?
It will have a huge impact. 50% of Intel's revenue, even after the nasty decline that they've suffered in PC and laptop sales, that segment is still half of Intel's revenue. Intel absolutely needs the PC market to bottom and rebound this year. And it looks like it is starting to do that. Intel and I think AMD even more aggressively so. That's the more than 60% year over year decline versus Intel's 37% decline in client group, basically PCs. They got aggressive in burning off excess inventory out there, which kind of sets them up for a return to sequential growth. Both of them, I think, the back half of 2023. Although AMD did say it looks like they'll return to sequential growth starting in the second quarter. So maybe a little bit ahead of Intel. We'll see. But to answer your question, yes, this segment is a big deal for Intel. They need PC to rebound. AMD less so. Only 14% at this point of AMD's revenue is tied to the PC market. A lot of that is by design, I think, because of the Xilinx acquisition. I don't know that AMD is just going to cede market share to Intel on purpose. But if you're going to cede market share, right now is a fantastic time to do it when, there's no profit to be made in that market. So, yeah, Intel needs this market to make a comeback.
Okay, that makes total sense, doesn't it? And Pat Gelsinger stated, "We remain on track to regain transistor performance and power performance leadership by 2025. So he said that they are quickly mastering EUV technology with Intel 4 as their first EUV node. So where are they at in this process? Their plan was to develop 5 nodes in 4 years. So where are they at in this process, and how much progress are they making, and how quickly are they making it?
Yeah, basically they have 2 nodes left in the next year and a half to meet that target. I've noticed there are a lot of investors out there betting on an Intel rebound that are ready to take a victory lap. And maybe they're right. Maybe this is a turning point for Intel, but I think it's too soon to say that. I noticed one article in particular pointed out that TSMC is having its own issues ramping up its next gen manufacturing. But I would bear one very, very important point in mind here. TSMC is still ahead, and so they're blazing a new trail that no one else has before. Intel is getting the benefit of TSMC having already blazed that initial EUV trail. So of course they're mastering EUV quicker than TSMC did a few years ago. Uh, if Intel pushes ahead in this tech manufacturing roadmap ahead of where TSMC is, they could hit some speed bumps, especially as we hit the high NA EUV machines from ASML. That's new stuff. We'll see. We'll see. There's still some questions there. I wouldn't be ready to declare victory yet here and declare an Intel rebound. There is still a lot of work to be done. The company really needs the PC market to make a turnaround for that next gen manufacturing technology to even be profitable for them in the first place. And they've kind of missed the secular growth trend from data center AI that's being gobbled up by AMD and NVIDIA. So Intel's fate really, I don't think, lies just on them hitting these process manufacturing nodes on time. They need that, plus they need the demand, the robust demand to be there from consumers and businesses. So we'll see. I think it's still too soon to say Intel has turned things around.
I have one more question on their milestones that they're trying to reach. They mentioned that, let's see if I can find it here. There is in the business highlights, it says Intel's AI hardware accelerators run inference faster than any available GPU. So we've been talking a lot about AI chips and how much power is needed to access some of this artificial intelligence. So what does this mean exactly? That their chip is faster than any GPU out there?
Yeah, that statement really deserves some extra discussion. It needs nuance to it. There are a lot of computing workloads out there. Remember, they're referring to cloud workloads. AI inference is after an AI model has already been trained. And inference is when that trained model now goes out and provides an answer. So like if you use ChatGPT and you ask it a question, inference is when ChatGPT comes back to you with an answer. Some of Intel's hardware geared for this runs more efficiently than some of AMD and NVIDIA's stuff. This is the same thing that like kind of Google and Amazon did with some of their chips too. They said, our in-house designed chips are more powerful than NVIDIA's. And the nuance there is at a certain level of electricity usage, they're more powerful. They're more efficient. So there's lots of different workloads out there, and a lot of these different chips are specifically geared to a particular workload. And so that's basically what Intel is saying here is that, for some certain workloads, their AI chips are pretty good.
Got it. Thank you for the explanation there. So let's just talk a little bit more about their revenue segmentation. The one thing that did go up for Intel was Mobileye, which was 16% year over year. So we've seen this through a lot of earnings, in all of these companies, that the automotive segment is what's really, really propelling the growth here.
Yeah, I like the chart that you made a number of months ago here on Intel segments, Casey, and you can see on the updated one here, Mobileye, like the lone growth segment for the company. You also pointed out, just to pivot here, because we're going to talk about automotive here shortly, later in the show. You pointed something out here that I think we knew was coming, but then promptly forgot about. Intel's accelerated computing and graphics segment is gone. It's no longer here. So you actually had to delete part of your graph. What do you think about that reshuffle in Intel's business?
The foundry services is what they replaced for the segmentation of the accelerated computing and graphics, which we know that the foundry services is not doing anything right at the moment. But it certainly looks like they've moved those pieces from the accelerated computing and graphics section to some of these other segments like client computing, data center and AI, network and edge, so that the numbers would look slightly better.
Yeah, and accelerated computing was not a pretty looking segment there at the end of 2022. Very, very small, to the point that it was really almost an insignificant part of the business, losing money. So they kind of reshuffled things around. They did have a key executive departure from that segment too, which places even more doubt on Intel's ability to really compete with AMD and NVIDIA over the long term. Another thing that's concerning here, and especially when you have AMD, not just doing really, really well in the AI CPU space, as they highlighted on their earnings call. Intel's data center and AI group fell 39% year over year. AMD's was flat year over year. So significant market share increase for AMD in the last quarter is what we can imply from that. And then in addition to that, they're also picking up steam in AI and other areas with their embedded segment. That's the Xilinx acquisition that they completed last February. That segment continues to grow. And so AI for, you name it, healthcare, automotive for like advanced driver assist systems, maybe self-driving cars, again, some ancillary parts for data centers. All across the economy, AMD has AI solutions in place. They're recognizing growth from that. Intel at the moment, not so much, with the exception of Mobileye.
Let's take a look at the outlook for both of these companies.
So we're just basically being a broken record here at this point. The whole industry, especially the PC market, is looking like it will begin to return to growth by the second half of this year. So I think Intel will get big benefit from that market. However, AMD has the additional tailwind working in its favor from data center and AI. That market is also expected to return to sequential growth the back half of this year. And they have that very strong embedded segment as well. So I think roughly both companies are kind of on the same trajectory for the next 6 months. And that's fantastic news for them and for the whole economy, really.
Yeah, as you mentioned before, we really would like Intel to succeed here. This is a foundation company for this market, so it's very important that it succeeds and progresses, as well as AMD. So that being said, if you think that we've read a lot of articles, I've seen some videos about Intel making this great turnaround and why it's a good buy right now, because the expectation is the stock price is going to soar once they get on top of all of these plans, these milestones. But how do you feel about constructing your portfolio around a company like that, where there's a huge potential for upside because things look so terrible right now, but there is a possibility that doesn't turn around? So what are your thoughts on constructing your portfolio based on this factor?
That's a fantastic point, Casey, and an issue that I think we combat a lot in our line of work. We're not stock jocks. I think we're more interested in constructing a portfolio. There is still a tremendous amount of doubt that Intel will succeed in a great way over the next 3 to 5 years, especially. Turnaround strategies do not work that often in the tech world, or if they do, the turnaround doesn't return the business to total market dominance. But if it does, in the rare case that it does, it's not a short endeavor, and it's very expensive. So I think it's too soon to say, yes, Intel is going to succeed in a great way from here on forward. But I'm not going to knock anybody for betting on Intel. There's a good possibility the stock is grossly undervalued from here, and it could increase. However, two things. First, it's going to be difficult for Intel to be a semiconductor stock market outperformer. I think there's a good chance that the ETFs SOX, SOXX, or SMH, both essentially, the same semiconductor stock portfolio, those two ETFs actually outperform. Second, if you're thinking about portfolio construction and you're betting too much money on a company to not just kind of get back on track, but retake the industry by storm, if you're betting too big on that, you've got money at risk, because there are a lot of other businesses that want to sustain their newly captured lead over Intel. So I think it's really important that you construct a portfolio versus placing a bet on a business. This industry, semiconductor industry, is remarkably difficult, and I think investors would be served really well if they do invest in Intel to diversify. Maybe it's AMD, maybe it's not. Maybe you do so with other companies. Maybe you buy the stocks that Intel is relying heavily on to regain that lead, like the chip fab equipment companies. Applied Materials is our favorite, ASML Holding, and here later in the episode, we'll talk about KLA Corp. Hedge the bet, construct a resilient portfolio. Don't make wild bets on a very, very uncertain future. I think that's an important thing to bear in mind here with Intel. It's just too soon to say it's a for sure thing. This business is now going to succeed.
That seems like very wise advice. Let's talk about Texas Instruments and onsemi. Last week, we did a very brief update on Texas Instruments, went through some of the numbers, so we don't necessarily need to go through all of that again. But since that time, Semiconductor reported. So let's run through some of the financials.
Okay, yeah. So Texas Instruments, we said last week, their revenue fell 11% year over year in the first quarter, basically in line with expectations. onsemi, by contrast, exceeded expectations. Their revenue went up 1% year over year, so nothing to write home about. However, growth is growth, especially when these companies are dealing with some similar cyclical downturns as Intel and AMD. So onsemi specifically, the 1% year over year revenue growth to basically $2 billion. They did report some tightening in their both GAAP and adjusted operating margin. GAAP operating margin of 28.8%, on an adjusted basis 32.2%, which was down just a couple percentage points from the previous quarter and from the previous year on an adjusted basis. So basically, the takeaway here, overall, it was a good quarter for onsemi. They seem to be managing the current cyclical downturn, particular in consumer electronic related businesses. They seem to be managing that in a much better way than Texas Instruments is.
Okay, and as we mentioned in the previous segment about Intel and AMD, we were talking about the growth of the automotive part of the industry, the automotive segment. And Semiconductor obviously has a huge play in this. You can see that 50% of their revenue comes from the automotive sector, another 28% with the industrial sector. So what are some of the things that ON is doing in the automotive department to stay ahead of their competition?
Yeah, that's good points there. Maybe just a moment, I'll back up on the one point you mentioned on the automotive and industrial now making up almost 80% of onsemi's business. a couple years ago, just a year ago, it was less than 2/3 of revenue. And we have a management team here that we actually really like. We have a lot of experience with CEO Hussein Al-Khoury, CFO Thad Trent. They were previously at a company called Cypress Semiconductor, and that got acquired by Infineon, one of Europe's largest IDMs and an on-semi peer, as is Texas Instruments and ST Micro that we reported on last week. So they have really kind of right-sized the business, walked away from business that generates lower profit margins, refocused on higher margin stuff, which I think they targeted the secular growth trend early on and said it's going to be automotive, it's going to be industrial automation. Let's bet big on that and reposition the portfolio for that.
Yes, On Semi has invested heavily in silicon carbide technology in support of the EV powertrain, the advanced driver systems, and in-car digital infotainment displays.
Yeah, this is the one. On Semi is the one company we know for sure that's buying that silicon carbide test equipment from Air Test Systems. So there is one issue here with On Semi, and that is, I think, the free cash flow generation for 2023 is going to dip quite a bit because they're purchasing all of this equipment to ramp up silicon carbide. They think that they're going to hit the $1 billion revenue rate just from silicon carbide this year, which is pretty significant. This was just a couple $100 million business last year. But what I like about it is they're doing so profitably. They have the money to spend on this equipment. If you compare that to a company like Wolfspeed, losing tons of cash, in need of investor dollars, in need of CHIPS Act funding to sort of complete their fabs and ramp up production to a scale that actually turns a profit. I think a lot of investors maybe got tricked into that one, not fully realizing how expensive and how long it was going to take Wolfspeed to ramp up. Meanwhile, On Semi, $1 billion run rate on track for silicon carbide this year for the automotive market, specifically EVs. ST Micro that we reported on last week, $1.2 billion run rate from silicon carbide sales in 2023. That's pretty good. So when you mentioned earlier, new chip substrates, new chip materials, a key growth trend, and it looks like On Semi is one of those companies that's successfully making that transition. Okay, so let me kick it back to you with a question here, Casey. On Semi, we finally, I'll say, re-added to our portfolio just a very, very small nibble. Texas Instruments, not in the chip stock investor portfolio. How do you feel about that one?
Well, I kind of like Texas Instruments, and not just because of the calculator that I know so well, the TI-83, but the company is obviously a very good company. It's been around for many, many years and has had this steady growth. However, as we've been talking about, are they making the most advanced chips available? The answer is probably not. And especially in this market that's growing so large, the automotive market, they haven't really invested a lot of research and development into it. So I like On Semi in this space because of what we've been discussing. It's at the very cutting edge of the market. It's developing these new chips that will be in the vehicles of the future in the automotive industry. And Texas Instruments is just kind of doing what they do best. So it's a low and slow growing business.
And this is where maybe investing preference comes into play, because you're right. TI, a fantastic business, but not the most exciting business, at least as far as growth goes. That being said, I will say this. I did not like how management handled the earnings call last week. Analysts had a lot of questions, and I think they were valid questions given that, the revenue is falling and the market is just in a bad spot right now. A lot of investors worried about the economy this year, and TI's markets, specifically automotive and industrial, will grow over the long term. But the question now becomes, because they have this focus on parts that will not quickly go obsolete, they can kind of continue to crank out production, increase their inventory, and just wait for the next upswing in demand. Fine. But how long until that next upswing? In addition to that, they do see lots of demand from the parts they do produce right now. But to meet that future demand, they are also having to invest a lot of money in capital expenditures to expand their fabs. Going forward for the next few years, they said that they're going to average $5 billion a year in capital expenditures. This is a company that just a few years ago, kind of up to the point of the pandemic, this is a company that averaged about $1 billion in capex. So we're going from 1 to 5 in just a few years. Texas Instruments has always, for many, many years now, prided itself on free cash flow per share growth. And I'm now not so certain we're going to see much free cash flow per share growth in the next 3 years or so. That makes me nervous about this stock. And that's another reason I think I like On Semi as well.
I do want to ask one question, Nick, about the CHIPS Act and how that will affect Texas Instruments. How do you think they'll use the funds?
This is something that they were a bit cagey about on the earnings call and have been really for a few quarters now. Basically, yes, they're going to get some CHIPS Act funding, and that's going to offset some of the capex and help prop up their profit margins for the next 3 years as they go through this phase of expanding their fab capacity. But we don't know how much benefit they're going to get. And this is another thing I think both of us have struggled with here. The semiconductor industry is huge. $600 billion a year, headed towards $1 trillion a year. These fabs are incredibly expensive. Just one of them can cost tens of billions of dollars. CHIPS Act funding is $52 billion. It's not really designed to save companies that much on cost. It's designed to kind of kickstart investment in US-based manufacturing. Something similar going on in Europe as well with the European CHIPS Act, roughly 42, 43 billion US dollars. It sounds like a lot of money, but it's not really. Just one fab, again, this is a very high-end fab, so it's especially expensive, but TSMC's new fab in Arizona is $40 billion just by itself. That's one facility. These things are expensive. So the CHIPS Act will help Texas Instruments, but it's not going to be a life raft for investors that are looking for massive profit growth in the short to midterm. So this one makes me a bit nervous right now. I think, and again, this capacity expansion is not geared towards next gen parts at the heart of, let's say, an electric vehicle. This is more of the same parts that they don't think are going to go obsolete very quickly, that they can kind of just continue to do their thing with, that they've always done.
So I guess the conclusion that we can come to about Texas Instruments is that if you are a investor that's interested in buying some shares and letting it sit and letting it grow, collecting the dividends, Texas Instruments may be a good solution for you. Is that kind of what we're thinking here?
Long term. Think long term here on this one. I think you really have to look 3 to 5 years and beyond on this one before you start to see some really, really great significant traction, at least in profitability. But I think maybe the same as with Intel and the AMD discussion that we had before. I think it's important to think about not placing a single bet on a company, but instead think in terms of constructing a portfolio, diversify around Texas Instruments. Maybe that means buying one of their smaller peers on semi that is focused on some higher end, higher growth markets like those silicon carbide chips. Or again, if you have this expectation like we do that chip fab equipment is where all that CapEx is going from Texas Instruments, invest in some of the companies that are going to receive the CapEx spending. So build a portfolio rather than just place a bet on one single semiconductor player. And because again, I think there's risk with TXN here that they're kind of happy to just ignore the tech trend of the moment. But whenever that happens, there's always the risk that you get left behind if you don't at least try to capture a little bit of that market. This is one of the many reasons why Intel is in the boat it is today. So hedge your bet, build a diversified portfolio. Before continuing, let me remind you to hit the like button and subscribe to the channel if this video is helpful as you do your own investment research and increase your knowledge of business and technology. We really appreciate the support, as subscribing to the channel helps us continue putting out content like this.
So why don't we move on to a company that does supply some of this wafer fab equipment, KLA Corp. Let's talk about their earnings here for the last quarter. And I'll just briefly go through some of the numbers there. So the revenue was $2.4 billion, gross margin almost 61%, operating margin close to 39%, net income $698 million, earnings per share $5.03, and free cash flow $926 million. So the revenue growth was 6% year over year, but they had a bit of a decline since the last quarter. So can you interpret some of these numbers for us, Nick, and tell us exactly where KLA is sitting?
Yeah, the chip market is all over the board right now. But one thing that's pretty cool about KLA is they are continuing to grow. The revenue was up, like you said, just a bit year over year, but earnings per share actually, in spite of the profit margin compression, this company returns all excess free cash flow in the form of dividend and share repurchases. So earnings on a per share basis actually increased 4%. And then the free cash flow shot up 28% year over year. So even in a down year, KLA and its peers, Applied Materials, Lam Research, all of the chip fab equipment makers, with the exception of ASML, largely expected to have a down year. Basically, there's this kind of brief pause going on as some of the new fab construction gets underway. You have to build the shell of the fab before you can start filling it up with all the equipment. So basically, there's this brief pause right now. The memory chip market is also in disarray. KLA getting benefit from just their scale, basically. They're focused on a lot of higher growth markets, the mature manufacturing nodes like automotive. So still slight growth. And as they enjoy like their higher scale, the profitability can still go up overall. So this one was quite impressive, I'd say. It was a good quarter.
Maybe we could talk just a little bit about who competes with KLA.
Well, KLA, like you said, is the dominant player in their particular type of chip fab equipment. Basically, process control, yield control, metrology. They measure features on chips, and it sounds silly, but it's a very, very important step in the wafer making process. So yeah, some of the competitors, Applied Materials, ASML actually makes some equipment specifically for the EUV space in metrology. There's another company called Onto Innovation that we have a very tiny position in as well, that kind of focuses in on some higher order process control and metrology. But KLA, by and large, the dominant player in this particular space.
And as you mentioned, this analysis and process control, according to Gartner, is the fastest growing wafer fab equipment market in 2022. So it grew 30%. So you can see how big of a share that this company has. We can see that 90% of their revenue comes from the semiconductor process control. And of that, 86% is for foundry and logic, only 14% for memory. And not to be outdone, KLA also plays in the automotive space. So let's talk a little bit about what they supply in to facilitate these automotive chips.
Yeah, of course, if you're a chip company these days, you have to mention automotive and silicon carbide in no particular order, but those two things, automotive, silicon carbide, KLA dropped both phrases in the earnings call. And, perhaps for good reason, though. Like you said, the process control segment of fab equipment, fast growing last year. And it would appear it's going to continue to outperform, not necessarily grow this year, but outperform the broader fab equipment space in 2023. And a lot of that has to do with these companies ramping up capacity for the automotive industry that is approaching a $700 million annualized revenue vertical for KLA. And they said 5x growth in silicon carbide related business. So roughly half of their total automotive sales, specifically for silicon carbide. So maybe that was maybe ST Micro, maybe Wolfspeed. We don't know, but it doesn't matter. They're going to supply multiple companies. And so this is another one that I think if you like the automotive space, if you like the EV industry in the coming years, KLA is an interesting stock to consider. And even in a down year, it looks like profitability can at the very least remain stable, if not go up. They pay a dividend, they repurchase stock. This is a pretty great company if you're looking for dividend growth and some share price appreciation over time. Obviously, we want that too over the next 5 to 10 years. This is a very compelling business.
Another point to mention here about the growth of the company, a lot of these equipment manufacturers have been having some restrictions placed on their sales to China. And that, of course, affects the profit. But KLA did mention that they have seen a higher than expected investment from some of their legacy customers in China, and they've received some clarification from the US government on the export rules that were issued in October. So that now they can resume some of their shipments that were previously excluded. So China in particular is a very large portion of the market. 26% is their revenue from that region. So that is also a positive factor for KLA Corp.
Yeah, good call out, good find there listening to the earnings call, Casey. It's another positive trend working in KLA's favor. We have received some questions about who makes fab equipment in China. There are a small handful of very, very small companies based in China that do it. But if you want to build a fab, you have to go to companies in Silicon Valley or the Netherlands, almost exclusively. So this is a good thing for KLA here to have maybe a resumption of sales for China as they kind of work through some of the export controls here in recent months.
So in the earnings call, the only downside I would say is that the outlook for the second half of this year is a little bit fuzzy, but it appears definitely to be trending in the positive direction. So we have high hopes for KLA.
So yeah, Intel versus AMD. Maybe just to reiterate some of the themes I mentioned at the beginning, tighter integration between hardware and software. We're really, really seeing that in the AI market. And maybe AMD, to a lesser extent, historically has focused on software, but that appears to be changing here with the advent of AI, moving to new chip materials. We kind of worry a bit about Texas Instruments here, but still a great company, probably a fantastic long-term dividend stock. But in constructing a portfolio, consider companies that are betting on these new materials in a sustainable fashion, like on Semiconductor. And then the chip equipment companies. If you want to build a fab and you want to build new chips featuring new architectures, you've got to spend hundreds of millions, if not billions of dollars on the fab equipment makers. KLA had a fantastic report, great stock. I think we're kind of optimistic about what Applied Materials has in store for us here in a couple of weeks, aren't we?
Yeah, absolutely. We still have Applied Materials coming up. Our other top stock of 2023, Qualcomm, is also going to have earnings later this week. So there is a ton of great information that we will go through and give to you as soon as we possibly can.
Yeah, stay tuned, everyone. Thanks for watching. See you again soon.